This is the first of what we expect will be many, many programs like this at the Silicon Valley Capital Club. So on behalf of the club and the board, we'd like to welcome you all. If you're interested in membership in the club, just a little pitch, Rob. Please come and see me or any one of my council members. And with that, I'll turn it over to you. Thank you, Rob.
Thank you.
Well, I do want to thank Ron, Chair of the Business Forward Council, Board of Governors Chair Lynn Surf-Gross, Club Manager Bruce McKenzie, and Eric Lopez, Member Relations Director. So quick round of applause for those folks. All right, so ladies and gentlemen, here's the schedule for tonight. We're going to have a dynamic, spirited, entertaining, controversial discussion with our panel.
We'll try hard.
I'm just a pod of the plant to make sure they don't talk too long. So we'll do the discussion till about 35 after. We'll open up the questions from the audience. We are recording this event, and it will be made available to Capital Club members. When it's time for Q&A, we have a microphone that will go around the room if you have a question. It's not to amplify, it's to record. So keep that in mind. You don't have to keep telling me, hey, it doesn't work, it doesn't work. It's to record, not to amplify. So without further ado, I want to welcome our distinguished panel, two of the top venture capitalists in Silicon Valley, Ephraim Lindenbaum and Nuno Goncalves Pedro. Let's give it up for them. So, tell us about yourself.
Sure. So I'm Ephraim Lindenbaum, and I'm a recovering entrepreneur. So all of you entrepreneurs out there, I come from your world. And if you've seen me talk before and you've heard that before, you know, that's my only line. So effectively, I started in Silicon Valley when I was very young, too young to know any better. Started my first company, grew that through the late 80s and 90s, exited in the first dot-com boom, probably around the time some of you were born. And then, spent a little bit of time with the acquirer in Dallas, which was terrible, never moved to Dallas. And then in turn, came back to Silicon Valley. And it's really binary when you're an entrepreneur in Silicon Valley. When you sell or exit a company, you really have two choices, right? You either start your next company or you default and become an investor. And I like to joke, I really didn't have any good ideas at the time, so I had to become an investor. So we spun up Advanced Ventures in 1999, myself and a couple of partners, and we're one of the few remaining 99 vintage venture funds out there, which means we're either pretty good at what we do or total gluttons for punishment. And we've invested since. We've now invested through 3 funds, getting ready to do our 4th. We invest across a couple of core areas. What we do is interchange kind of core tech, which evolves over time, with different verticals. So in our particular case, when we started, we were consumer-facing internet and communication boxes and closets, and also things like sustainability. And that evolved, as you imagine. Consumer internet became business internet, became SaaS, became cloud, became AI, and now it's quant computing, who knows, right? And then on the other side, communications were boxes and closets, then mobility, now today is very much mobile and IoT. And then the area that we're most excited about, that we have the greatest fun right now, is on our sustainability side. We're big investors in categories like agriculture and food technology. And that's really an area where you can save the planet, as well as, obviously, as a VC, make a lot of money, hopefully. And so we've got some great companies in that space. If you go to the store, if you pick up a company from Alpha Foods, vegan, plant-based foods, really healthy for you, and that also helps our cause. So they're great. Very rapid scale on our companies, where we've got some companies that are reinventing the protein business, how you create protein, highly sustainable. And then, just to kind of rip the Band-Aid off, we're also investing in a category called hemp and cannabis. We don't invest in plants per se, because that's illegal, but we invest on the ancillary side of that. So categories of technology there. And we have a really interesting thesis in that category, which is it's a high-value market. It's a high-value crop. And it allows technology to not have to deal with as difficult a margin environment where everybody's making a lot of money. People are willing to deploy capital for technology. So we're using that as an adoption curve killer for other technologies. So something that might not be as effective at gaining traction in other verticals might find a home there and grow very rapidly. So that's something we're doing. We're very lucky. We've had about 14 or 16 exits over the years, invested in too many companies to talk about. Our flame out rate, whatever you want to call it, it's about 73%, which sounds absolutely terrible. If there was any other business and you got 73% of them wrong, you wouldn't be in business, right? But in our business, That's actually pretty good. We typically invest $500,000 to $2 million per investment. We do anywhere from 3 to 5 a year, and that's basically it. So thank you.
All right. Nuno.
So my name is Nuno. I'll start with the most value that I'll create all evening. There's actually free seats over here if anyone that's standing wants to sit down. That's about as much value as I'll create. So I'm a venture capitalist 2 times. I'll get back to that in a second. I'm really a masochist. And I've been in tech for 22 years now. Computer engineer by background, became an engineering manager, product manager, because obviously I wasn't a very good engineer. And so I had to move on to management roles. Ended up working as an operator in a variety of growth type roles, so mostly around product, corporate development, business development, strategy, what we now call business operations for some reason that I don't fully understand. So did that for quite a while. Just a little bit of a parenthesis, I've worked in over 35 countries. I've lived in Beijing for 6 years, London for 3 years, so I've been all over the world, which has given me, I think, a lot of perspective on different ecosystems. I've been on boards of directors of companies in Asia, Europe, and here, and I can guarantee to you they're very, very different. Investors behave in very different ways. We can talk about that later if that's at all interesting. In the last 12 years, I've been back and forth to Silicon Valley, and then the last 7.5 years based here. 9 years ago, I decided to do something fundamentally stupid. I decided to do a twosome, which is become a venture capitalist and an entrepreneur, which is really, really stupid. Because if you think being an entrepreneur is difficult, try and be an entrepreneur in venture capital. Not really a very scalable industry where you raise money based literally on people, literally on track record. There's really no product. We did a couple of really interesting innovations with my first firm, which I still manage, called Strive Capital. We're probably the first quant VC firm in Silicon Valley. Now there's been a bunch of new articles. Every year there's some articles on hedge fundization of VC and data-driven VC and whatever. We were really the first guys, and we actually did it. So we actually developed an analytics engine in-house. It helped us derive 65 to 70% of our top of funnel of deal flow, which is really pretty ridiculous. And it helped us do due diligence on companies, etc. That fund invested in companies like App Annie, Keep Safe. Our first investment, a company called Anish, IPO'd on the Tokyo Stock Exchange within 2.5 years of our investment. We were first money in, so that's pretty stellar. Failed miserably at raising my second fund, so I know the pains of being an entrepreneur. And then sort of resuscitated it as a family office, which I still do on weekends. So I did that, over the last 1.5 years. And I did 5 investments over the last 1.5 years. Companies that you would know, 3 very early stage companies, so those you probably would not know, but one around aeroponics, robotics, and computer vision applied to indoor farming. Another company around talent and recruiting with some really smart people that have figured out that actually talent now is king. So they're tipping basically the flow of recruiting on its head by going directly to the talent, figuring out if they're actually the real talent, and then figuring out what would make them leave the companies they're in, and only then connecting them to companies that might be the right companies for them to go to. And finally, a company around blockchain. I'm bearish short-term, bullish long-term on blockchain. So we have an investment in a platform around custodian, which is still under stealth mode. We also invested in 2 companies that are pretty well known in Silicon Valley, probably I'd say 2 out of the top 3 hottest deals of the last 3 years in Silicon Valley. A company called Gusto, which used to be Zen Payroll, the new Zenefit, so to speak, and a company called Rubrik, which is one of the fastest growing companies in software as a service and platform as a service here in the Bay Area. And my day job, because that's my weekend job, as I said, I was already clear about that, is with Grisham Robotics. We're a Sand Hill Road VC firm. We do Series A and Series B, mostly around hard tech, so things that have a hardware component to them. Our name is not sometimes the easiest to understand because people think we do robots, and actually we don't only do robots, and there are certain types of robots we don't do, which is very, very confusing. So we don't do industrial. We do maybe 30 to 40% B2B, and then we do 60 to 70% B2C, so consumer stuff. So think of it like Ring.com. We invested in them, sold to Amazon. Eero also sold to Amazon, so Amazon bought all our smart home portfolio, which maybe it would have been easier if we would have done some deal with them at the beginning, I guess. We did a company called Zoom Pizza that raised $375 million. That's actually a robotics company, so I'll take credit for that. Last year, exactly. Well, we love food tech. We'll get back to that in a second. So yeah, food tech, robotics, yeah. They do use robots, which is cool. And then invest in a couple of other companies that have been pretty mind shifting. Starship, you may have bumped into them in Redwood City. They're these little white robots that do deliveries. Zipline, that does long range delivery of blood and medication, starting in Africa, but they're actually an Afghan Bay company, and a bunch of other stuff. So that's what I do, and I am officially a masochist. I guess that's it.
I feel tired just hearing it. It seems
I
like
am
way
tired
too much
just
work.
talking, yes.
Like you're gonna ruin our whole quadrant, man.
Yes.
I don't know what's
When
happening.
do you sleep? That's the...
Yeah.
Anyway, so it's July 17th, and a lot has happened in 2019 so far. We've had 5 major IPOs, and there's just a lot of stuff going on.
Hundreds
So,
of IPOs.
huh?
Hundreds.
5 major ones. Anyway, so talk about 2017 thus far, and what do you see happening the rest of 2017?
19.
2019.
Okay, Rob. Someone's working too hard here. Clearly, I feel really lightweight in the middle here.
2019.
So over the last couple of years, venture capital has raised a tremendous amount of money. There's a lot of money that's coming into venture. There are many different flavors of venture capital than there's ever been in history. When I got into this business, there was sort of early stage, traditional, and then private equity growth. And that was it. There were 3 flavors, like chocolate, vanilla, and strawberry, right? There were no other flavors. Today, it's like make your own flavor. So there are a zillion different options. There are more accelerators, incubators, micro VCs, semi-micro VCs, early stage VCs, quant VCs. I mean, I don't know. I'm waiting to see the, et cetera VC. So from that standpoint, it's a great time to be an entrepreneur. I mean, that's really, it's a tougher time to be a venture capitalist, right? Because, we always joke that a lot of our investments disintermediated other businesses, right? Banking, real estate, taxis, Uber, et cetera, right? Now we're getting disintermediated ourselves by all of this changing, right? So from that standpoint, being a great time for an entrepreneur, we all have to keep raising money. And to Rob's point, this has been a phenomenal year of IPOs. And it's not just the Ubers, which by the way was not a great deal for us, that you hear about it. It's the smaller deals out there, like Personalis, which is a company that does genomics, which had a tremendous IPO. Everybody made 10x on that. Plus. So there have been a tremendous amount of great IPOs. Now what that means, it creates liquidity for us, which means we distribute money to our investors. They get richer, they give us more money, rinse and repeat, right? The tough part is we've hit, and this seems to be a theme when I have lunch with my other venture buddies, that, right now is kind of an odd time from a technology spectrum, right? There tends to be, and many of you might be aware of it, there's like these hype graphs out there about different kinds of technology, right? And we've seen a lot of them over the years. A couple years ago was the big VR hype. I think I did 5 VR events with Rob, right? I can't find anybody that came to that event. What happened to him? I'm not sure. But, actually VR is finally coming to pass now. So, I think that the challenge in our business is being out in front, but not being out so far in front, right? That you miss the window to be successful. And we've seen a lot of booms. Right now we're having the second coming of the crypto boom, right? The crypto was huge. Everybody was into blockchain and cryptocurrency, et cetera. And then it went off a cliff, right? And then you couldn't find anybody that would say the word cryptocurrency. I mean, I watched VCs scrape that off their website, and in essence, I think the way we view it is a little more holistically, right? As I was just joking with an old VC friend that our firm did a deal with Garage Ventures in 2003. So, we've been doing this for a while. I joke, we invested in an AI deal that had a major exit in 2003. Okay, I got to win there. I'm not going back because it just couldn't get any better, right? It's like Macbeth, right? It's halfway back or halfway forward, just keep moving, right? So from that standpoint, it's an odd spot because there's a lot happening in the enterprise. There's a lot of things happening around the areas like AI. Blockchain has kind of made a resurgence. And I think what we've really actually focused on is something completely different, which is, and not to sound like a value investor, we're looking for companies that are actually venture scale investments. And that's really hard because companies, and I'll give you an example, we have a company called Front Range Biosciences. We invested with them in kind of the tail end of 2016. They had 0 revenue. 2017, they had 0 revenue. They were building their company. They had just raised, they finally closed their round at the beginning of 17. In 2018, they had about 1.5 million. This year, they're going to have 7 million. Next year, they're going to have 22 million. Okay, that's a venture scale company, both in terms of speed and revenue growth, etc. And it was really hard what they were doing. They hired a lot of smart people. They worked really, really hard. They almost hit the wall 100 times, but that's venture scale. And I think one of the issues that we're seeing is there is so much venture capital out there that much of the venture scale requirement's been lost. Meaning that if you're not going to see that hyper growth, when you're seeing an entrepreneur come back to you 3 years later, and they're at 400,000 in sales, and when you saw them last time, they were 250,000 in sales, it's not a venture deal. And I think what's most important to us is finding, both a technology area where we can add value, and that could be IoT, it could be AI, but really cross-hatched with a vertical we like. Like, for example, financial technology. We love it. We've had a bunch of exits. We kind of know what we're doing. We can be helpful. That makes sense. In the case of food or agriculture, we do CPGs, that's consumer packaged goods. We kind of call it a fetish. We do it every once in a while. We've had some good wins there, but it's very, very profitable when you have a win. And, along the way, we really look for those scales. So we have a company called Alpha Foods I mentioned. They were founded in 2016. They'll do $12 million this year. Next year, they will do 25 to 30 million. And, that is venture scale companies, right? And I think what's been lost here with the amount of deals that are available in the Valley, that these companies aren't able to reach scale quickly. And in turn, what you end up having is a lot of different companies that are creating a lot of noise, particularly in enterprise. When you have 100 startups trying to target the same customer with a slightly different flavored product, it's confusing to all of us, from our end on the VC, but really the customer. So what we'll try and do is cut through the noise and look for the real venture scale companies.
So 2019 and the things we're seeing, first and foremost, this is really exciting times. I mean, technologically, we are with acceleration curves that we've never seen before in many of these areas. The thing to be careful is that some of these platforms are actually not scaling that fast. In VC, I think there's this notion that we're paid to anticipate and figure out the future. I can assure you that's not what we're paid to do. We're paid to generate returns on the investments and the money that is trusted upon us, right? We are fund managers at the end of the day. That's what we do. We just do high risk investments, but that's what we do. So from our perspective, I don't like talking about value investments either, but I do like talking about, what do I call normal distributions versus power laws. What that means is, the classic VC likes the notion that, one of their investments is going to return 100x or 1000x, right? And so they optimize for that. They optimize for the $1 billion plus exit, very early stage if you're an early stage investor. We think that's an incursion of risk that is actually not due, right? So if you start thinking different ways, it's like if I'm looking at my investments, again, I'm an early stage investor, and I'm trying to look at 5 to 10x returns systematically on any company that I invest in, can I create a criteria set and a thesis that works really well with that? Can I be disciplined enough as an investor so that, let's say, 85 to 90% of all capital that I deploy fits into that, right? And if it fits into that, will my curve of returns look more like a normal distribution instead of one or two guys returns everything, best of luck there, right? Where you're incurring really significant risk. So that's the first thing that we certainly at Strive have done, and that sort of generates the quant dynamic to it, right? It's not that we think that algorithms will foresee the future. We think that algorithms allow us not to lose top of funnel, and that's part of the business we're in, which is we shouldn't miss deals as VCs. And everyone say, I don't miss any deals. Well, that's really BS, right? Because even if you're Sequoia and Benchmark, which are the tier 1 guys in the room, right? You will lose deals. You will not see deals, right? Because there will be this tiny little company in Bucharest that nobody's ever heard about that all of a sudden is the largest RPA company in the world. Excel is invested in them, right? But they are in Bucharest in Romania. They're not here, okay? So they're not within 30 miles of where I can have breakfast with my founders, okay? So the world, I think, has fundamentally changed. I think the notions of disruption will come from people like ourselves that are looking at the market from an investment standpoint and actually have a thesis that goes beyond the regular notion of the market. I think the other thing that's important to know, and you alluded to that, and going back, I think, to the original question that Rob was asking around 2019, we're seeing public markets that are incredibly well behaved and incredibly rational. How shocking is that? They're actually valuing companies properly, right? So this is not a public market bubble, which is great news, right? This is really very good news for us, right? This is not 99, it's not 98, right? We're in a market where Uber gets valued more or less at the value that a lot of people were talking about, right? And they've gone a little bit up now at 74, 75 billion, but it's more or less what they sort of should be valued at. Lyft is more or less in the same field. Pinterest is realigned. Zoom has gone up, which is great. So maybe they were a little bit mispriced. Slack has gone a little bit down. So we're having all these dynamics where public markets are actually being the agents of rationality. Well, that's great news. For us VCs, there's a perverse thing going on, though, and I think F might have his own perspective. Mine is it's actually very perverse, which is
I try and stay out of that tone. I was not here with the guy who just brought up that language.
Correct.
You didn't see me here.
We get our returns on liquidation, right, on exits. And exits normally have taken really only two forms. Trade sales, a company buys our company, right, or buys our IP, or buys our team, or whatever it is, or the company IPOs. And that's sort of it. And then we started having the crypto guys, and there's ICOs, and what is an ICO? Is it a security, not a security? Is it a utility or not, right? That's perverse by itself. But there's actually
You gotta stop using that word.
another form of perversion that I think is much worse than that. I'll continue using it, just for pushing sakes.
It's the European thing.
Yes, it's a European thing. We're not very good in English and
We
stuff
are
like that,
very
so it's fine.
polite here. We're very proper.
So which is really, you have hedge funds, you have private equity funds, you have family offices doing direct investments, you have all these players coming into the market who are propelling companies into private markets much longer than they should be private. And if you look at what happened to Uber, it's probably the sign of that. And that creates liquidation on previous investors. Because if I'm an early stage investor, at some point, I'll sell my stock in what we call a secondary transaction. And so I'm no longer incentivized that the company is actually successful in the long run. I'm just incentivized if someone else takes my shares off the table at a premium to me in return. Okay? Now that sounds mysteriously like other things that I will not name, that some of them are actually not super legal, right?
Where are you going with
Yes.
this?
So basically the notion for me, and this is in all seriousness, is I think the markets will see a decrease in actual ability to raise by the late stage guys, and this has been propelled by the Vision Fund in particular, by SoftBank. It will be more difficult to raise really large funds. That will stabilize that part of the market. That market has been overwhelmed with very high valuations and a lot of capital. I think that will stabilize. I think the thing we're seeing in early stage of a lot of capital, a lot of micro funds, a lot of new ones emerging will also stabilize, probably not this year, but probably next year in 2021. And that will be good for the markets because at the end, public markets are being rational. Hopefully we'll have private markets that become more rational and we'll all benefit from this. And we'll come in at lower valuations that are more reasonable with entrepreneurs that deserve them. So in some ways I'm positive that private markets finally will sort of readapt and slow down a little bit because we had a huge going up over 2013-14, and then there was a huge slowdown in 2016, and then again going up. I think at some point in time, I'm a big believer that 2019 is this year of transition where private markets will start becoming a little bit more rational, certainly into 2020. So that's my prediction.
By the way, who is an entrepreneur in this room? Okay.
All right.
Who's an investor? All right. Who's a service provider? Who's in the wrong room? No. So for the sake of the entrepreneurs in the room, what do venture capitalists look for?
Sure.
Start it.
Sure. So at a high level, each venture fund has their own. Certainly my colleague here has algorithms and things like that. We're just not that smart. We're sort of the AI behind it. And, and it's really interesting because AI is actually very well matched to it because, the secret sauce in venture capital is called pattern matching, right? What we're trying to do is match patterns that occurred in other businesses, in other technology cycles, right? And trying to make like-kind decisions saying, okay, well, we've seen this evolution in the technology stack before, and we can see how it'll evolve, right? Whether we're right or wrong, it's hard to tell. But in terms of what sort of orients our investment, we have, as my colleague said, what we've done is essentially we're money managers, right? So you have to kind of think about that. We live in the absolute tiniest little asset allocation of most either high net worths or institution, etc. We are the rounding error. in their allocation, right? So we can play pretty fast and loose by most standards in that particular category. However, though, when we do take their money, they ask for our criteria. So we actually have to make one up. And so in particular, ours is we have certain categories. So for example, in order to reasonably consider a deal, and of course we'll throw that out the window if the greatest deal comes along, but in general, there has to be a minimum viable product. We're looking for the basis of a management team, not a single founder, at least two. We like to see a technical and a business co-founder, right? And then customers. And that's a big word, customers. That doesn't just mean people you talk to, people think what you're doing is kind of cool. That means people that will give you money for what you are building. And the faster they give you money, and and we will speak to them, the more of a problem you're solving for them, right? And there are layers of problems, right? So we kind of group companies into two categories: what we call better, faster, cheaper, and brave new world. Right? And that's really important because it's how you evaluate a company, right? If you're looking at a company that is, let's say, making a better diagnostic equipment, right? That might be better, faster, cheaper. If you're looking at a company that's going to use an iPhone to replace imaging for medical folks so people in Africa can do something with a simple mobile device, that's kind of brave new world. So you have to really be able to package them and then think of them very differently from that standpoint. But if you start with the baseline, do you have a minimum viable product? Do you have a team? Do you have customers? Okay, that's where the conversation starts, at least for us. Now, for us, what we like to see, although we have said that there are certain minimums of monthly recurring revenue or annual recurring revenue, learn all the acronyms, MMR, AAR, these are really important. Now, for us, we don't tend to get caught up in that because we've seen too many companies go $10,000 a month, $20,000 a month, $30,000 a month, $30,000 a month, $30,000 a month, $30,000 for too long, right? So that's not always an indicator for us. What we want to be able to see is a clear line of sight, meaning that they've done business with a customer, they bought one system or X or software or license, and that customer is going to buy 10 more because they've got a pants on fire problem. And that's really what we want. We don't want just, maybe it makes it more efficient. We're really looking for solving big, big pain points for the customer. And so those are some of our models, right? So you have to have the basics, but then you have to kind of look at it and say, am I brave new world? Am I better, faster, cheaper? And then the metrics you have to apply to it are going to be very different how we think of you. Okay? So that's a high level.
Very good. So I'd like to start by saying we use algorithms, but we don't want to replace humans. Otherwise, I'd be out of a job, which is really silly. So we are strong believers that algorithms augment our ability to see specific deals, and they increase dramatically our productivity as a team. Venture capital firms are very small teams, right? I mean, 95% of all VC firms in Silicon Valley have less than 10 people. So if you have deal teams of, like, say, 5 to 6 people, right, assuming partners are actually pulling full weight and actually doing due diligences and stuff, which is
Rarely.
Huge question mark, right? And basically you have to increase their productivity somehow. And we believe that the systems that we develop, et cetera, and the tools help us be more productive. And if we are 30% more productive than the guys next to us that have similar assets under management, that are investing in similar areas than us, we're doing better than them in principle, right? Hopefully we are. So back to the human in the loop piece. We look at the classic things. It's product, market, team. It's basically that, product, market, team. We're early stage investors. We do Series C, Series A. That's what we look at. Within product, we go to the nth level. We try to figure out if there's technology differentiation, there's something in the architecture that makes eminent sense, that is different from others in the market. We try and figure out their sensitivity for product strategy, if they understand the market from an end user perspective that they're serving or not, et cetera, et cetera. Then there's market, and market is a lot about momentum, right? Back to the VR point that F was making, if VR as an attach rate, like number of VR devices or headsets in the world, is very low, people are not using it, right? Mobile apps was only hugely successful because there were a ton of devices in the world with app stores, right? So you can't second guess platform plays. You have to actually ride waves. If you're too early, you're dead, right? This is actually about timing. So figuring that out, figuring out competition, figuring out other elements of the market is really, really important. Team, we spend a huge amount of time on team. And we like a bunch of hacks. I won't share them all here today because then I would stop having the opportunity to actually use them. But basic things, one thing that people actually don't realize, can this entrepreneur or founding team raise money easily? Do they have the right sales pitch? Can they come in front of a VC firm? Will they be able to raise from other people here on Sand Hill Road?
We call that the Moses factor.
Exactly.
We
right?
call it the Moses factor.
So if you don't have
Do
it,
they have the Moses factor?
if you don't have it, you're done. I mean, going back to an example, you know, the numbers that you were quoting were incredible numbers, by the way, in terms of revenues over the years. We invested in a company that year one, and this is not revenues, it's bookings, but they did 5 million in bookings, right? Year three, they did 300 million in bookings, right? They're one of the fastest ever growth enterprise software companies in the world. Now, the question you should ask is how much money did they raise, right? Because they raised a bunch to get there. They raised really, really fast. And they scaled like hell. You know, will it work over the long term? I hope so, right? Because they'll have all sorts of issues with their org as they scaled, right? But they just did a land grab. They went to the market and they did a mass land grab. And they just took it. So the ability for the entrepreneur, in this case the CEO, to fundraise was it. There was nothing else. He basically obliterated his 3 top competitors on the second year, right? And he was actually late to the market. So that type of thing actually matters a lot to us. We're obsessed about product market fit. And for us, product market fit takes a lot of different signals. We invest very significantly around consumer. Around 70% of what I do probably is around consumer. So for us, product market fit doesn't probably show elements of monetization very early on. It probably shows elements of what I call retention engagement, and the number of users that are active users, what they do with the apps, what they do with the online services, what do they do with the actual product that they're being pushed to do with. And so we spend a huge amount of time on that. Is it getting better through time? Right? Are the cohorts, as they call them, the newer cohorts, are they behaving better? Are people sticking around longer, right? Is it not just the numbers of active users that are increasing, but is their engagement actually increasing? And we obsess about that. And the reason why we obsess about that is we found over the years that's the only way to have a shot. It doesn't mean you're going to win, but to have a shot, you have to really nail product market fit in these dimensions, in particular if you're looking at the consumer side. So in effect, those are all the dimensions we look at. I think anyone that comes to the table and says, well, you know, it's just these 3 things, will be lying. It's not true. We'll see all sorts of things, right? We'll see whether the dynamics of interaction between the CTO and CEO are good. You know, one hack I used to do, I'll give you a second hack. This one's for free. That we used to do is we send, you know, someone from our team. It could be actually even a partner. It doesn't necessarily need to be an associate or a principal. We send them to spend time with the team to look at, you know, basically, sometimes we used to be very outbound driven, so they didn't even have a pitch deck. So we'd help them develop a pitch deck, which for them was great value. Or we'd spend time with them in their data room. They don't want to share too much information, so we go in to their office and spend time with them. The hack there is pretty simple. You see how a team works on a daily basis for 3 days. Who's in at what time, when do they leave, how do they interact with each other, right? After 3 or 4 days, you sort of fly on the wall. You can start seeing the dynamics, you know, do they get along, do they have lunch together, right? Do they work well, et cetera, et cetera. All of this stuff actually fundamentally matters, right? And I personally believe that that's one of my superpowers as a VC. I like spending time with entrepreneurs and trying to figure out, do these people have the grit they need to have? Can they withstand the pain? I mean, I think Ben Horowitz talks about this all the time. You know, you're an entrepreneur if you can withstand pain, right? Because if you haven't gone through pain, and you, I think, alluded already to this, the ups and downs, right? If you haven't gone through ups and downs, it's probably not going to be a big deal, your company, right? Either it's a lifestyle business or it's going to fail miserably pretty quickly. But if you go through the ups and downs, how do you react to it emotionally and psychologically? Someone recently told me, you know, one of the most core skills that we need to have as VCs is being psychologists. We need to figure out if these people have the ability to actually build businesses, to bring talent on board, to lead that talent, and to create organizations that hopefully will have a positive culture to move them forward.
And that's a great point, because what do we do after we give you money? And that's where, you know, you're effectively marrying us. So, you know, we've talked about the Tinder process of dating as we've just gone through it here. But at the end of the day, when you're signing up with the VC and you're taking our money, we are now on board. You have now married us. And a lot of that process is what we also do beyond that, right? We're board members. We're very active VC. So we take board seats. We, you know, do spend a lot of that psychologist time there. I do believe that factor of absorbing pain, both having done it as an entrepreneur myself, but also we're a huge proponent of female founders. The last deal we did was a female founder-led deal. And every single female founder-led deal we've had has been a success. So, you know, I think that comes down to organizational skills, which, you know, maybe whatever. I'm not going to try and drive that back to where it came from, but it seems to be there. And pain, right? I mean, pain is clearly a factor. And so, I think there are a lot of trends out there that we tend to look at. And to me, I do totally respect the depth in which the technology and otherwise goes. Having been doing this as long as we have, I think we've realized that the best tech doesn't always win, and the best team doesn't always win. And I think one of the things we've realized as, successful, at least we're still here, venture capitalists, has been that it's a club sport. Which, similar to whatever sport you want to look at, there's a club sport, which means it takes a club to get it done. And, as it was alluded, there's some big brand name VCs in town, and they can muscle their way through it. If you raise enough money, you don't have to have the best tech. I mean, we all wouldn't be, Windows wouldn't exist if the best tech won, right? Okay, but they had a lot of money, and they had a lot of traction, they got a lot of inside deals done. And those are other elements. And for all the rebel that was created in Apple, one could make the exact same case. They were as big or bigger bully than anybody else out there. And now we have new bullies like Amazon, right? So a lot of that comes down to the fact that as we were talking about, it's looking at the skill set. I mean, we call it the Moses factor. It's a little sexist, but it's a good reference since we don't know if that person really existed or not. I mean, whatever. The short story is if you had like a biblical understanding of it.
We'd like to believe it, I guess.
Hey, I'm there, man.
The two of us,
I'm
yeah.
like your short Jewish friend. Give me a break. So
The Catholic and the Jewish.
there you go, man. But if you think about it, the guy got everybody to walk into the Red Sea up to their neck before it parted, right? And that's what you need an entrepreneur to do. So to me, it's always been, can the entrepreneur recruit people and get people to do things that they didn't think they could do? To take risks? Could they go steal a VP from some big company that's worth 100 times theirs because that entrepreneur has so much conviction that they can make that happen? And I agree, fundraising is pretty much the key CEO job for the first couple years of a startup, because that is the oxygen in the room that keeps them alive, right? And as I tell all of our startups, your day job 100% of the time is raising money, and your day job 100% of the time is running your company. And you're the one who has to figure out how to get them all on the same day. That's not us, but you have to do it. So being able to, get good quality people that work with you, being able to trust your team. So all the things that we were talking about in terms of being in there. I don't think maybe we get as deep on some of the nuances, because I think we tend to look at other elements as well. Like, for example, the club sport. What other VCs? I mean, very, very rarely today are we seeing deals that wasn't a direct introduction from someone we knew, who already had money in the door, and is not going to give you their bad deal because they want to be your friend still, right? So there's a lot of high school dynamics that live in all businesses, and definitely in the venture business, which means if your friend at Lightspeed or Sequoia has invested in a deal, they've invited you into the next one, there's a pretty high probability that, just given the sheer amount of capital behind it, they could be successful. And then you apply all the rest of your metrics there. But as an entrepreneur, I think it's important that you're looking to solve big problems. You're looking to find good tech. These are some things that were distilled from the conversation. Big problem that the market really cares about, that generates money quickly. Big themes. I had to.
I held back. That's okay.
Okay.
Let's hear it for the panel. So we'd like to take as many questions from the audience as possible. We have a recording microphone. So who has a question for the panel? Hang on. Use the microphone.
Just going to pass this around so sync it up with the video.
Hello. Since I'm asking the first question, I'll keep it on a lighter note. You guys mentioned a great deal about how the selection process is, what you tell your partners, and what you do with entrepreneurs, and how the opportunities are. There's some formulas, pseudo formulas, and all the great stuff. I would like to know how much of a gut feelings you guys exercise. Say you think that somebody's work in progress. You think that they're not exactly talking about what you wanted to hear, right? But you see the potential. There is that gut feeling. There's that invisible thing that you see in some entrepreneurs. I'd love to know if there was any stories or things like that you ever looked or considered.
So I have a bunch, and it's a little bit. F was talking about pattern recognition, right? It started with pattern recognition. It started with the guys I passed on that I shouldn't have passed on, right? And I had a particularly prolific 2012. I passed on Snapchat before they raised their Series Seed for 185K from Lightspeed. And it was actually a difficult Series Seed. It took them a while to raise it.
Oh, yeah.
And so that would have been Midas list top 5 for me personally, but I passed on them. And so I went back to that. It's like, why did I pass? And that's, you remember where I was saying we're not in the business of being right? Because I was right. I was right about all the issues they were having around product and, intellectual honesty on product management from Evan, et cetera. I passed on Stripe, Series B, and I passed on Grabbed before they raised anything, which is now the Uber of Southeast Asia, well, the Uber plus of Southeast Asia. And that was the worst because one of the co-founders was my business analyst at McKinsey, and she asked me to be an advisor 3 times. It was really, really silly. I mean, but
Are you sure you should be doing this? Because it really sounds like
it was
talk.
It was
You got some things
it
going
was,
on,
It was a
but-
traumatic year. But what that taught me is, I do believe in thesis driven. I do believe in normal distributions. I talked about that earlier. And I do believe that 80, 85, maybe even 90% of the money you deploy as a fund, right, should go towards that and towards the thesis that you build. And again, F might have a different view. This is my view and how I structure the way we do things. But then there's the question around what happens to the other 10 to 20%, right? And I do think that 10 to 20% needs to go to very high risk bets. In my country, in my home country, VC is not called VC, it's called risk capital, right? And that's the definition of venture capital. Like
there's actually venture capital in Portugal?
Yes, there is.
Oh my God, where'd
and
that
we're
come
hot
from?
in Europe now. We're
I
very,
can
very hot.
imagine.
We're very hot. So anyway, long story short, I think now I am willing to make those bets. And it's a small portion of what I allocate, but I'll make the bet. And normally, it's actually almost always very driven by the founder, CEO. Very, very driven. Potentially the product is something unique. I just actually almost did a deal recently. I was just, slow by a day to get into the deal on something where I saw these guys could be maybe the next Snapchat plus, the next Instagram, if we want to even look at better analogy. And it was about the founders. There was something about them that I was like, I've seen this before, again, pattern recognition. And that was, I would say, 90% gut, right? There was things about their product I really liked, and I could have gone back and backtracked it with research. And sure, they're going after Gen Zers, and I could say Gen Zers are really going for that, and I understand Gen Zers and whatever. But in reality, it would have been a 90% gut check. But I wouldn't do it for 90% of the bulk of what I deploy. I would do it for my 10%. For me, there is. I think there is.
Right, but I drill it down to one thing. If you're a single entrepreneur that thinks you've really got something and we're just going to take a risk, no, don't believe that. Because that's just not. Where the gut plays out is we've checked a bunch of these other boxes. Mm-hmm. Now it's a gut, and it might be amongst 3 or 4 teams. And also just by way of helping understand, the decision-making process in a venture fund is a unanimous decision, meaning all the partners have to agree. So you've also got to remember, not only do you have to convince me I want to give you money.
Depends on the firm. Some firms are not unanimous.
Well, that's true.
Yeah.
That's true. I mean, but in general, that's the general theme, right? If the partners get along, which is a whole other thing. But in general, that means that once I think that I want to invest in you, then I've got to go convince 2 other people. So, part of it is also arming, your patron, so to speak, to be able to go out and do that. But the concept of someone who's just got this, single person with this great idea and we're going to kill the world, very low. I mean, the probability is very low. Yeah. Now, if you came in with 3 other people, you've all done it 5 times before, you had a public exit, sure. If you walked in, you're like, I think I'm going to, have a, on-demand painting company. We're like, great. You got 3 exits, we're good. How much you need? That's it.
Next question.
So, like I said, I am an entrepreneur. I have started several companies, but I still own them. And I happen to start a media company. And as you know, the media company is everything is a high tech and this and that. But what I realized a few years back, that I don't care how high tech you are, one thing is McDonald's does not advertise to poor people like you and me. McDonald's advertise Happy Meal. Okay? Why is that? It's a very simple. The same reason I started my company, the digital media company, and I started advertising to the renters instead of homeowners. Because most homeowners, by the time they become homeowners, they already know who they're gonna do business with. They're not gonna change. So I figured that out, and it took me almost 6 years and a lot of my money. And now we are doubling and tripling our sales from last year to this year. But it took us over 6 years to get there because people wouldn't trust our name. Now they trust not the name, but the results. The business owners, they are working with us and for 5 years, 4 years, and they are doubling and tripling their sales. So my question is, I'm looking for someone that can help me scale my business, because my business in the form where it is right now, it can be scaled nationwide in less than 2 years. And how do I find those people or the VC that can help me get there? Because I'm good at what I do, doesn't mean I'm good at scaling.
Well, so I think it's important for you to understand that we're not in the business of helping you operate. We can recommend people to hire. We might refer you to a recruiter that could be helpful. But frankly, we're looking for you to come to us when you found that person. Because as we talked about, having a team involves someone like yourself who's created the concept and put in the blood and the pain and all the other elements like that goes into it, and that you found that next person that can help you do that. Now, that being said, we will help companies at various points, but that's not our job. Our job, you've got to remember, we have jobs, right? Our job is we get money from investors. We have to make decisions on where to deploy it, and then we have to sort of sit on that egg tangentially, not actively, in order to get you and help guide at a much, much higher level strategic line toward your goal, right? So that's not really the right question for us. The question that I would have to you is, there are a lot of great websites. I think Founder Dating is still out there, and that's not to go get a date. That's actually to go meet a co-founder. LinkedIn is a treasure trove of co-founders. And when you come to us, we're going to say, where'd you steal this person from? If you stole the VP of sales from XYZ big company, and she is this incredible performer, and somehow she left that big company to join you, that is a tremendous impact to us. We're going to say, maybe he's got something, because he convinced her to leave that huge job to go to him. So I think that's something you kind of need to do before you come to us.
Yeah, I think adding to that, finding someone or the right elements and people that would be the people to help you expand is one option. I mean, you mentioned McDonald's, very good example of that, because they have franchisees. So the notion of franchisee, it sounds strange in media and technology, but we've seen players do that. Some, like Rocket Internet, the European guys, used to do that play over and over again, where they'd get young kids. They actually stole most of them from McKinsey at a certain point in time, and from BCG. They would give them almost nothing in the company and let them run like the special operation for that country. And some of it worked really, really well. So that's another angle. It's almost like a franchisee angle with bringing someone from the outside who's full of blood and going in and whatever. I would say there are probably some small cap, mid cap private equity firms that are more specialized on operational areas that might be more linked to your specific area, but that gets super mega specific. It's probably around media and how do I scale, and there might be some guys that have the right bench and right talent and operating partners to help you with that, but it's a bit uncommon. Even in private equity, most investors are very financially driven. There are very few guys who are solely focused on the operational side. So for me, those would be like the 3 or 4 options in the menu that you would have to scale. I don't think VC is the right angle for it.
Next.
So my question is around IP. Like, how important is the IP for you guys when you decide to invest in a company, and how many IPs do you look for? Because some people told me one is not enough because a big player will come and kill you, and some others still said that it might be enough for the initial funding. And related to this, the second thing is, how much is the minimum you think for seed funding? Because some people say it's like maybe around
As much as you can get.
yeah,
That
like-
is the
yeah,
ideal
like
amount.
500K, and some people say that less than 2 million in the Bay Area doesn't even cover your market cost. So if you ask for less than that, then I don't think you really know the market. So
So I'll start with the IP one. as I said, I'm mostly around software and, consumer hardware, B2B hardware, so where IP is not really what's going to make you win or not win the market. I do occasionally do sort of frontier tech AI investments, and there it matters a lot more. I think IP matters particularly in terms of defensibility. And what I mean by that, for example, I just looked at a company, I won't say in which area they are, but they were actually in the hard tech space. And one question I immediately have is, okay, you guys haven't raised a lot of money, you're selling a lot, which is great, so you're a great sales and marketing machine, but you have not patented anything, which is fine, but you have 3 big players in the market that have raised a ton of money. And one of them had raised like 20 million and they hadn't launched anything. So these guys had launched, they were doing revenues, and then there's some guys on the other side who haven't launched anything, and they're like, well, look at those guys, they haven't launched anything, they're not making money. It's like, well, wait a second, but how many patents have those guys filed? And then it matters to me if you can protect your IP. It doesn't matter to me if you're going to enforce it, because you're not, right? And I don't give you money for you to enforce IP. It matters to me if someone else can say, by the way, you're infringing on my patents, right? And you have nothing on your side to stand and defend it. So that's how I look at IP in my spaces. Again, I'm not a frontier tech only investor, which would probably care a lot more about those things. Normally you'd see if there's technology differentiation, there's always filings and there's always at least provisionals very early on. If there isn't, it's a bit odd. But for me, that's not a big deal unless there is someone else who's built it, right? And then it becomes an actual problem. The second thing about, seed and pre-seed and friends and family, like classically, there's friends and family, I think in the new classic way, right? Because it used to be, as you said, early stage, traditional, mid to late stage growth, right? That was it, or private equity. And now we have all these sub areas going on. I think we have now friends and family, right? Which are people that know you. It's your first core people. How much money can you raise from them? And I don't know if you can raise a lot or not, but that's the beginning, right? Then there's sort of what I would call the pre-seed, and pre-seed can go for a while, but could be angels, super angel firms, et cetera, right? So the first one probably gets you, I don't know, 100 to 250K. The second one is, I don't know, 250K to 750K, maybe $1 million max, right? A proper seed these days is actually, it used to be $1 million to $2 million, but the new seed is actually not that. On average, 2010, most companies prior to a Series A in the Bay Area had raised 1.8 million. So just prior to Series A, in 2018, that number is 5.4 million. Okay, so actually, the Series C now is almost like the new Series A, 3 to 5, right? Okay, so for me, again, going back to F's point, and I absolutely agree with him on this. It will be one of the first ones in the evening. Is how much you can raise, right? Now, if you can't raise if you've worked in corporate roles, if you've worked with people around you, etc., and you can't raise any money from people that we would potentially see as high net worth individuals, that's a relatively negative signal, right? If people that know you that have money are not willing to give you a 10K check or 25K check, that's negative. So when people come and talk to a VC who normally will only come in at, let's say, Series Seed, right? If you're in an early stage or micro venture firm to ask for money and you're raising $1 million and you have no money from anyone, that's normally a pretty negative signal, right? It's if you haven't been able to raise from other sources in the market, it's a bit odd.
We also like you to actually have a plan, right? Which really means, where are you going to use the money? So, whenever someone comes into us and says, we want $10 million because we think that's the right number to ask for, they're not going to get any money from us. Because, I'm not asking you to come in with needing $6,300,700,022 either. But what I want you to be able to do is understand what it's going to get you. Because it's not going to get you all the way to the finish line, but we need to understand it's going to get you to the next milestone or multiple milestone or the next urgency event to get funded or the next point. So I think those are very, very important aspects. And the other thing we've got to talk about is it doesn't take that much money to do things any longer. You can go, there are a zillion accelerators. There are teams that are going around going, the chairs and the snacks are better here, so we're going there versus here. They'll give me $12,000 and a better chair. So I think you can go through and find that. But, the first step is, what do you really need and how far does it have to get you? And I do agree that getting money, you don't have to shake down your family though. And I don't believe that's the case because we call it the 3 Fs, right? Friends, families, and fools. Actually, I don't like companies that have taken a lot of money. I would rather see, frankly, an entrepreneur that's maxed their credit card out to the point that if they don't succeed, they're going to die. Because that really is much more motivating to me than living in their parents' basement and like getting a check every once in a while. That is not as impressive from my standpoint. So that would be it. Then the other thing is IP, and that's a loaded question because I think Nuna said it right. In some cases, it just really doesn't matter, right? If you're doing a new biotech drug, it's everything, right? If you're making a slightly different flavor of business intelligence software, it's not whether you have IP, it's whether you're stepping on someone else's IP that makes the difference, right? So you've got to think about your business. We don't know your business. It might be 100% IP driven. It might not. So don't let anybody give you a stock answer for that.
But my question regarding consent family was like the reason, at least so far, I haven't gone for that is because there are too many people in the mix, right? Because everyone has kind of a stake in what decisions you are taking because they're invested.
Yeah, I mean, we call it the 3 Fs. I mean, if you can navigate, that's great. If all your family members are super rich and don't care and want to give you money, that's great too. Most people don't have that. I want to see, we had a deal where all 3 founders were living in this little apartment in Mountain View on top of an ambulance service, right? They couldn't afford an office yet. And anytime an ambulance would leave, they were on a conference call with the client. It's like, whoa! And, and it's like at some point we looked at it and said, we're just going to give these guys money because they deserve it just to get out of that place because they were working so hard. They used to make their own beer because they couldn't literally afford to buy it. I mean, and I'm not kidding. I mean, and that's that pain that we were talking about that, you see people, and hopefully, it's not for a stupid purpose, but they had a great company, which we invested. We took a Sequoia invested, and then we sold it to a public company all within the span of about 16 months, right? Clearly these guys had something, and that team's gone off. Members of that team we've invested in 5 times now. Different members of that original team. So a lot of it is what did they have, the grit, whatever you want to call it, that it was a big part of that.
And how about bank offers?
Next question. Sorry.
Can you comment on the role, the status of social venture capital in 2019 in Silicon Valley?
What does that mean, social venture capital? Impact or
Yes, impact. Social
impact investing?
Well,
I
we co-invest with a ton of social investors. So if you want, do you invest with many of those? I mean, I'm happy.
I don't co-invest with a lot of impact investors, but I would say certainly some of my investments that I've made, even at a personal level as an angel, that have been the best investments, just if I look at return on paper, have been dramatic impact investments, either around healthcare or energy or something that is related to fundamentally impactful. I would never make a call just on impact. That's not my mandate as a fund manager. It's not what I established with my investors. But I think that's going to become more and more du jour, so to speak. So it is not going to be about just the fact that you generate a lot of cash, that you get great returns, etc. It's going to be much more around what's the purpose that drives that type of capitalism. The cool thing that I'm seeing is that actually is now starting to happen even in public markets. You see guys like, I saw the CEO of State Street Advisors, who I'd never heard about, by the way, which makes me someone who really doesn't understand the public market financial services market that well, that they have 2.8 trillion under management, just to be clear, right? So they're the 3rd largest asset manager in the world. And he was saying that they're now talking about, impact indexes. They're now talking about purpose-driven capitalism. They're now talking about things like climate change, workforce mobility. They're now pushing indexes to the companies that they invest in. They're now forcing boards to make decisions on their CEOs because that's their biggest point of leverage, to make decisions on that. So I think the future is actually relatively brighter than it was certainly a couple of years ago. BlackRock's doing an initiative on that as well. So I do think there's movements on that. I'm not an expert in that area. I would just say, for me, I think it's just good practice, right? If it impacts the world, it's probably going to be really, really big. But maybe you have a much better perspective on this.
So we're co-investors. I mean, the Steve Jobs family office called Emerson Collective led one of our deals to one round ago in our plant-based protein company. There are a lot of flavors of that. This has gotten a lot more complex. So there are social themed investment funds that actually have a financial mandate. There are funds that are perpetual, meaning the family's created a foundation around that, and all they have to do is check a box in order to get the return. So it's really quite dependent. In terms of Silicon Valley, frankly, Silicon Valley has always been just a desert of philanthropy, sadly. I spend a huge amount of my time on nonprofit boards, and I will tell you that it is, it's just terrible. And I have a thesis, which I won't go into at great length, but it happens to be that most of the entrepreneurs that founded this place were kind of, no offense, math geeks. Okay, math geeks were not highly social. They were like, in the chess room, playing chess club, and didn't see a lot of that. They often, one could make the case, they often suffered from other little challenges that went along with hyperintelligence, which didn't make them highly social. The highly social people went off to New York to be in media or Washington to do business, to do government. And so that piece was always missing, and it has not been educated well. We do see a thematic now, predominantly North Peninsula and North Bay based, which is driving that forward to a large degree. But but it's really shame based. I mean, if Benioff wasn't shaming the rest of the people, there wouldn't be much out there. So it's super sad.
It's shame based, and it goes after. I'm on board of a couple of nonprofits. It goes after the big nonprofits, right? And so it's actually taking a lot of the air from the smaller nonprofits. So it's shame-based, it's big checks, and therefore it has to go to the big guys because, who's going to take 10 million grant, right, from me? If I give you a 10 million grant, it has to be a big organization. So I think it's actually even more perverse than that, what's
All right,
happening
we have
right now.
time for one last question. Make sure it's a good one.
Well, I have a question on the lighter side, maybe because you said it's the last question. I'd like to figure out how do I put it. So let's imagine the world before Uber, right? So there were so many taxi companies, there were so many who wanted to take Uber, and I think there were many investments done. And the common man had an option to actually go and download so many apps in order to find his taxi. And then Uber came consolidated, so all common men go approach one app and then get the taxi done. So why the venture capital is like, I have to come to this event, I have to talk to you, I have to go to some other event, talk to. So why does the venture capital world didn't get into this Uber models? Why, as an entrepreneur, everyone should go and approach so many VCs? Why the VCs don't consolidate into one like Uber, and we entrepreneurs would have.
I want a job. So if we did it like that, we would. So what he's asking is why don't we disintermediate VCs and make it easy for entrepreneurs to go and kind of come to us as a single source money bank? So unless you see an ATM machine here somewhere and that you can put your card in, and I'm not going to spit out money. So if you take us away, one, I need a job. Two, there's a lot of human plus machine intelligence that goes into our job, and to the point of one of the other entrepreneurs here, there's a lot of gut feel that goes with it too. I mean, we don't operate in the public markets or the scientific world to a large degree. We can do that as part of our investment, but at the end of the day, we're making decisions that frankly even computers are just barely scratching. Was that a great team? Do they have a chance? When you talk to the customer, what did the customer sound like? Were they so excited to just tell you how great it is because they want that company to survive? So there's so much nuance that really humans can only capture in that's a big part of it. And then you also have to understand that, look, for every LinkedIn in the world, we funded. I remember when LinkedIn, that's how long I've been doing this, was getting funded. Does anybody remember Plaxo?
Yeah.
Does anybody remember Plaxo? Okay, those were the two that won. We funded 500 other companies that look just like those two companies. Same thing with Uber. There were 50 or 100 Ubers plus out there. The number one thing was Uber got a lot of money really fast. They got a lot of big friends, and they were super, super nasty bullies.
So,
end of story.
So I think to your question, giving actually a non-humorous answer to your humorous question. It's actually two things. One, there has been, to a certain extent, a little bit of Uberification of investment with crowdfunding, with AngelList. It's much easier to raise money early on than it has ever been. In Silicon Valley, in Lisbon, in China, wherever you are. I mean, maybe too easy, I would say, actually. And again, back to the point that F is making, we are professionals. At the end of the day, we are paid to do what we do. We have certain responsibilities to our investors. But there's a lot of people out there just writing 25K checks as angels that do it because they think it's cool, right? And so there's not a lot of professionalism around that. So I think there a little bit of that at the early stages already happened. Two, actually this industry, and going back to something that he had said before, actually hasn't been that disrupted at all, right? The only disruption that's happened is you have more micro stages along the way. But the guys who control the market are still more or less the same guys, right? Maybe you have a new couple of firms that have emerged over the last 10 years, but they're following the same playbook
Yeah, but
that they
disruption-
have done before.
But you called it. If everybody could throw in $25,000 and now you've got a mass of noise of companies that should never have naturally
But
selected.
this serves the VCs. This is the thing I think a lot of entrepreneurs don't understand. The fact that there's a lot more capital early on, the 25Ks, et cetera, serves the VCs. Because if I write bigger checks, if I come in at Series C or Series A, I'm in a cherry picker's market. I'll cherry pick. Who makes it or not? Well, there's a bunch more for me to choose from. Instead of choosing from this, I can choose from this. But I'll still choose my 5 to 6 a year, right? That doesn't change. And the disruption that happens is guys like Andreessen Horowitz that come to the market that actually then manage to raise a lot of funds and say, our approach is we're going to help founders through a shared services approach. They don't call it that, that's what I call them, right? That's it, and that's a disruption. It's sort of disruptive, right? I would say Sequoia's done some of that. There's been a couple of other funds who've done some of that, right? You know, then there's the guys who say we're quant, like us, right? That's a bit of a disruption. If you do it at scale, it might be a big disruption, right? But there hasn't been any big disruption in the market until now. And it's not coming anytime soon. It's not going to happen in the next 5 years, right?
No, but I think you actually fund the disruptions in other segments, but you don't fund the disruptions in your.
Why would we do that?
Why do
I
we
want
do
to keep
that?
my
Of
job.
course, yeah. No
The
point.
taxi guys
No
weren't
point.
like, let's go fund Uber. Okay.
Yes.
That was not their plan.
On that note, let's give it up for F and Nuno. So thanks for coming. We'll see you next time.